All right, let's kick it off. We'll be on time here. Thank you guys all for joining today. My name is Derek Scarbrough. I'm the CEO and owner of GLC, International Freight Forwarder Customs Brokerage Operation, and also a 3PL warehouse and distribution facilities in Los Angeles and Chicago. I wanted to set some of the ground rules here for today about what I was hoping for, which is really an interactive conversation. I've got my little list of participants up there, and anyone can use this react button here in Zoom to just raise a hand, and something comes up, I'd love to call on you there. And you can hopefully unmute yourselves and talk to us there. With the odds are that if you have a question, somebody else has the same question. These are some historic and unprecedented times we're dealing with here. So as interactive as we can all be, I think it will increase the level of learning, and hopefully the level of impact that we can have here together. I also have a presentation that I'll be going through with 6 main points that everybody who signed up for today, I'll make sure gets the emailed version of the presentation to them from me today. And I will work hard to navigate through this as best as possible for us. One of the big things that I think we recognized and why we wanted to do this today, or why I did in particular, was it's so important to be in constant communication together. Everybody is trying to navigate this together. There is no playbook on this. This is unprecedented. And so working together and staying involved in strategic and decision making now is as important as it's ever been. And so we want to facilitate conversations, and more importantly, I want to be at the table. I want to be at the table with everyone here, and how I can provide that support, whether it's through education, or also strategy, because at this stage, our business is contingent on each other. I mean, we need you guys to be successful. And so that's really why we wanted to dedicate the time today to it. So without further ado, I will share my screen here, and we'll get started on the presentation. And I will try my best to keep looking for any hands that pop up. So let's get going here. Okay, hopefully everyone can see that, and off we go. So the big 6 that I wanted to cover today are kind of the current tariff situation. Where we're at now, what we can expect moving forward a little bit there. The country of origin guidelines, that becomes, I think, really important from a strategy side about, options, things to consider. The bonded warehouse versus the foreign trade zone, the differences in those two, and the types of bonded facilities and what would make the most sense, most likely for anyone looking for those options here. A little bit on the strategy side around production and overall market conditions, about what we can expect both now and moving forward from my best version of that. Some sourcing and diversification topic to go over there. And then at last, Section 321 and T86 entries, which is more of that de minimis, which has just recently changed as of May 2nd. So some stuff to get into a little bit. On the current tariffs, one of the things that this is the timeline, how we found ourselves here. Back in Trump's original term in 2018, we started with the Section 301 duties and taxes, which at the time, again, historic, all based on your commodity, your HTS code being used. And the duty rates for just the Section 301 can range anywhere from 7.5 to 25%. Most everybody who's been importing over the last several years is already familiar with this, already dealt with this, already pretty aware of where their products fall. One thing that was interesting that despite all the things that happened, Biden, when he came to power, that's one of the only things he didn't really change. He kept that in place, for all of us. So the Section 301 is where we got started. We did have the Section 232 that started in 2018 as well, which was really geared more towards steel and aluminum. But then this year is when we started to see some even bigger changes. The first round of what were these IEEPA tariffs, as they were called, which was initially a 10% hit, a 10% addition to any goods from China and Hong Kong. March, we then saw that increased to 20% for China and Hong Kong, and the 25% tariff for Canada and Mexico imposed. except for goods that were of USMCA qualifying criteria. USMCA was what really replaced NAFTA, which most of us grew up and were the most familiar with. So that's kind of how we got there. And then the big ones is what I'll call the universal tariff or the reciprocal tariffs, kind of one and the same, which is this slide here for us, which really changed the game, giving basically a universal 10% across the board for anything imported in addition to the applicable duty rate for your goods. So we had that go into effect. Initially, they were postponed for other countries at greater rates as he's working on deals and things, as we know. So that July 9th becomes a really important date for everybody to see what will happen at that stage. Will we have deals with certain countries, multiple countries, all countries? What will really happen there? And so that, of course, remains to be seen. I think everybody is betting on the fact that we will see some deals prior to July 9th. But who and how much and all of that is really the big question. Of course, with those universal or reciprocal, China got the 125% on most goods, in addition to the already mentioned 301 and IEEPA duties and taxes. So really tough to swallow. As we look through, there are a couple of exceptions, with the steel and aluminum, the Annex 2 items, and goods that were of qualifying criteria of the USMCA. But that was really it when we got there. So that's where we currently are, as I think most people are pretty well aware. This section deals a little bit more with those exceptions on the steel and aluminum. One question we're getting a lot and seeing a lot in entries is, goods that are entirely steel or aluminum versus goods that have components of steel and aluminum. And so the components need to be potentially isolated out on a commercial invoice for us so that we are able to claim a little less duty on those. Those would be 25%, but it's not just a flat 25%. It also includes the Section 301 if applicable and the 20% IEEPA on items that are from China and Hong Kong. So it is a benefit because 25 is a lot better than 125, but at the same time, it isn't just 25. So it's important to understand some of these steel and aluminum exclusions here. So we are currently isolating those on entries, for the components and things to recognize the value, but most likely that's something that you wouldn't have been used to necessarily, separating out on a commercial invoice. So that would be an important thing to consider with your suppliers moving forward. This section is going to talk a little bit about, 4 different components there. I'm going to start with the DDP shipments because that's been a strategy brought to life by many people trying to say, okay, well, I'll let my supplier take care of it under DDP shipments and things. And of course, this is a possibility, but there's some things that we want to understand about DDP shipments before we go and do something like that. Number one, the DDP shipment, if done correctly, the foreign supplier really should be the importer of record in the USA. So they would be the one that's responsible for the duties and taxes and things. But in doing that, do they have any experience being the importer of record? Is this a brand new thing for them? Because, you would ultimately end up as the ultimate consignee on those shipments, which does bear some responsibility depending on, how the importer of record, if they default and how things go. So there is some culpability there. Some suppliers are actively aware of their responsibilities under DDP terms. Most are not, So it is, oftentimes we're seeing that where the supplier then wants to devalue the goods, have a lower value in those goods, of course, to circumvent duty. I would say that that's a very dangerous strategy for you and being involved in those shipments as well. Because customs has a record of previous activity of you being the importer and them being the supplier, unless they're opening up a different company name. So there's a lot of things to consider, when you start seeing that type of activity. One of the big impediments is the bonding that's required. Every importer is required to post a bond with U.S. Customs. There's two different kinds. One is called a single entry, which is good for each individual entry and is typically billed based on a commercial invoice value. And then also what's called the continuous or yearly bond. And so one of the things we've begun to see now from these insurance and surety companies is they no longer want or will cover foreign suppliers to get a new continuous bond. Now, that's a big deal. That's, again, historic, never before happened. But they're doing that because of all of the potential liability, fraudulent activity, etc., that is happening and high duties. And so in not allowing the suppliers to get the continuous bonds without first posting collateral, right, which is a big deal. None of these foreign suppliers are going to want to do that, or even understand how to navigate it. It really makes things a little bit more difficult on the DDP side of things. So a lot of factors to consider when doing DDP. Technically, you would also be relinquishing, you're still paying for the shipping, but you're relinquishing some of that control to the supplier to pick and choose who they want to work with, which could be many different people, and you're then contacted by a multitude of people on this end. So are you able to navigate with them and say, sure, let's move to DDP, but let's use, GLC or your preferred, forwarder and company in that process? But very important to consider on the DDP shipments. The valuation, all of these kind of go together. Valuation becomes an important component, for all of this. So how it would be a very poor decision to consider, devaluing goods you've already purchased from the same factory. There's census warnings, previous records, as the importer in previous shipments. That's one of the things that makes customs a little challenging, is that they have up to, I think it's 2 years, year and a half to liquidate entries. And so it's like this cloud that's hanging over your head for all of this time, where I've absolutely seen cases, more than dozens, where customs has come back well after a shipment and asked for additional records, additional documentation, and then issued customs forms requesting this information and billing additional duties. We have a case right now with a client where they've been billed $1 million in bills over the course of the last 2 years because they used a classification. So then they go back and subsequently look at all of your previous entries and all of that. And so, there are those cases that do exist. I think this administration has shown that willingness to go after certain things like that. So valuing, the goods properly is a very important piece of the puzzle, something that needs to be considered. And so, another danger in allowing, the supplier to do that. Continuous bonds we briefly touched on for DDP, but as importers, most of you have them. And so I think what becomes extremely important now is to understand which company you utilize to manage your bond, where you now stand within that bond, because every entry that's filed, it's like keeps a record and goes closer to, the threshold of where your bond sits. So the minimum bond threshold has always been a $50,000 continuous bond. But we've seen those become exhausted very quickly. That's supposed to represent 10%, of the duties that you would pay in. So it's important to know where you stand in your current bond. A lot of us will start to see, as we already have on behalf of clients, where our bond is insufficient. They're going to require us to go to that next level. And every level you go up, it gets more and more intense and more difficult. I've seen multiple people have to indeed give collateral, letters of credit, things like this to bond income just to be able to get the bond. One thing we have seen that I do think is an interesting strategy to employ. None of these solutions are perfect, but it is an interesting one as far as I've seen. We have companies who have multiple different business names, that they've opened up a separate company and then began importing underneath that company, getting a bond for that company. But I do think it's a viable option to consider, but at the same time, you always open yourself up to more things when you open a company. You got to pay taxes on it. There's more nuance to it, all the things that go with that. In addition, it's very important that you have a rhyme or reason as to how you're deciphering or delineating between which company is importing. right? Is there a different product line, different SKUs, different suppliers, different customers on this end? There needs to be, I would say, let's say it's a best practice to have an explanation behind why that other company is importing this and the other one's importing that, to be able to have some real clear distinction in that. So you definitely want to use this moment to know exactly where you stand on your bond. Just this morning, client we were notified was 94% of the way exhausted on their $200,000 bond. So of course we're going to them and saying, okay, what do we need to do to go to that next level? Is it collateral required? What can we do on their behalf? And we're actually sourcing through multiple different bonding companies now, and not just one, to see what is the best arrangement we can find based on those situations. Lastly, a quick slide here on binding rulings. That's always been a part of the game. It's a good feature to have, but it comes, like anything, with its pros and cons. When you request a binding ruling from customs, what you're really doing is trying to eliminate any confusion and get some clarity moving forward. A lot of the times when you're dealing with customs, there is gray areas or things up for interpretation. And so in doing the binding ruling, your goal is to eliminate that interpretation and have something finite. And so you're submitting a sample of your good with what you believe the classification to be, and asking them to then generate a ruling. And so with that, they will. Now, it could go in the way you hope, or it could go in a way that you don't, that benefits or harms you, but you do have finality there. The challenge after that is that you've got to use what they said. At the end of the day, you're now stuck with that tariff number to be utilized. So, only way to really circumvent that would be through customs attorneys and a whole bunch of processes that they don't lose often. I'll say that. And so I think it's really important to know if that's the right strategy for you, and to feel that comfort in the binding ruling category. But it is nonetheless, an important piece of the puzzle. Country of origin. I thought this was a really important topic because I'm in a group called Entrepreneur Organization with business owners all over the world, various different businesses. And, of course, all of them, too, are trying to find ways to deal with the current landscape. And, this idea of transshipping or changing the country of origin has now become a hot topic. So it's important to just understand what are the rules, what are you subjecting yourself to. So with that, markings, there's the marking component, which has never changed, but it has to be permanent, legible, visible to the end purchaser. But really, the country of origin is based on where that substantial transformation occurs or the essential character happens. So we've had a lot of people say, well, look, I want to send our cargo to Mexico, and they'll just package it, label it, and ship it. I would say that's not going to cut it. That's a dangerous roll of the dice right there, because the same situation exists with the liquidation and going back and getting information from customs. Even if you claimed it and got it through, that does not mean that it will liquidate accordingly, or that you won't have to provide additional backup based on when customs gets around to really reviewing that one before they would be willing to liquidate it. So, packaging or labeling is not going to be enough if you want to be on the safe side. Textiles are a little bit different. Of course, there's some requirements which are frequently missed, to be honest. The country of origin on the commercial invoices, the packing lists, those, I would say it's a very important thing to really scrutinize commercial invoices and packing lists harder than you've ever scrutinized them before, and get factories to come on board. Really important what we're isolating out on invoices, the valuation for those, the line items that are there, the clear descriptions, and of course, the country of origin should be listed on there as well. But I want to concentrate a lot on the substantial transformation, because that's really where it happens. Now, when we think about country of origin, there's a couple things to consider. One is the country of origin. To receive a certificate of origin from any country in the world, they may have different requirements than what the USA, qualifies as the country of origin. So if you want to go out and get a certificate of origin from Malaysia, well, Malaysia may have a very specific, process to legally get one. That they require 30% of the goods to be produced there or bought there. They may have their own requirements, but, U.S. Customs has theirs. And so I think it's important to understand there is a difference between those two. And really that substantial transformation, again, somewhat interpretive, right, with customs, but that's the important component. So where does that essential character, if you ship parts to Mexico and they put those parts together and assemble them into a machine, okay, you could make the reasonable argument that that machine was then manufactured in Mexico, right? But you can't do it just by putting that machine in a box, and putting a label on it. So I think that's always what you want to ask yourself, is when that essential character, when that item really becomes what it is. And so we've been really guiding everybody to consider if their product allows for it, shipping it in different components, different things, and then actually assembling, manufacturing that to be able to claim that country of origin. But very important one to consider there. Okay, the next big one, which I think kind of goes hand in hand with some of the supply chain strategy, concept. And we've had, customers on both sides of this fence, people think in both different ways. And I don't think there's any perfect answer here. It's just what works best for you and where you want to roll the dice, so to speak. Initially everybody had thought foreign trade zone, might be the answer, but that is, and this is a nice chart that'll show you, those things, but it's true you could do some manufacturing, in the foreign trade zone, and that you don't pay duty and taxes until you actually withdraw the goods from that foreign trade zone. You could, do that manufacturing and then export them out of the US and not have to pay any duties and taxes. But really the big key for what everyone was looking for was, well, what duty do I have to pay when it comes out? Right. And the duty is based on when it was initially entered into the foreign trade zone. So most likely, if you're looking for that reduction in duty, that won't be the best solution for you. But there is what's called, a bonded warehouse. Now, there's multiple different kinds of bonded warehouses. A CFS station, a container freight station, which is oftentimes where LCL, when it's consolidated together, will get shipped to the port, moved to the CFS station, and then made available for pickup and things like that. There's a finite time that cargo is allowed to stay there without some customs entry having to be issued. And it is not really the type that we're looking for if we're looking to bring merchandise here and then hold it until these tariffs maybe subside. And then get it out of there and pay duty based on the date that we're withdrawing it. What we've been able to find is that is indeed through this very specific bond type 3 warehouse. So it is a bonded warehouse, but they have to have that specific bond type 3 available. Most don't out there. It is a highly specialized thing. That really had never been previously needed. It's certainly not to this degree. So you can imagine the influx of calls and quotations and things that we're seeing and feeling out there in the universe. But a couple of really important things to remember there is that it is a 5-year time limit. The biggest benefit, like mentioned, is that if you have to do a warehouse entry, customs entry into this bonded facility, and at the same time a warehouse withdrawal. Most will allow you to do a withdrawal on just a portion of the goods. It doesn't have to be an entire container. If you want to take out 3 cartons, you can do that. You pay duty and tax based on what you take out at the applicable rate at the time you take it out. And so that's really the biggest benefit, I think, of what everyone's truly looking for as we kind of wait for these duties to subside. So what I would tell you on the bonded warehouse front, having been involved in setting a few clients up with that already, and also working through that with multiple, is that the ports, the East and West Coast ports, are a bit saturated here. The West Coast ports in particular, real saturated. The rates were crazy. They don't have any more space available, or at least not much, from everything I'm seeing out there in the world. And so our solution has been really more in the Midwest. We found a few good ones in Kansas City and Chicago that do have availability. And, you may have never previously thought to send your goods to Kansas City or Chicago. But at the same time, that goes into some of the strategy driven things about, well, what's best? What's best, to have cargo here believing and rolling the dice that a deal will be made, soon enough that you have cargo that is then ready to sell here in the States? Is it better to hold it in China, produce it still, not produce it still, and so that we'll touch on a little bit more of that in the market conditions, because I think you have to take those into account when you make that kind of a decision. But I would tell you that I have absolutely seen saturation at the East and West Coast ports. So considering the inland locations is important now. And I think we do have solutions there. So important stuff to consider when we look at bonded facilities. Again, now really would be mainly for the strategy of having goods here and available so that you're going to miss some of what is the production or shipping rush. So speaking quickly into that a little bit, again, no perfect solution here. It's all about what makes the most sense for you. I see a physical hand up there. Yes. You can unmute yourself there if you can. I don't think I can do it. You can't do it. You can do it. Cannot. Okay. Andrea, I don't know if you've muted everybody or if you can help us out with that, but hopefully he can unmute himself. And while we wait for that, I'll just keep going for a second. Keep your thought.
Okay, I'm seeing. Give me one second. Can you?
Oh, there we go. Okay.
Hi. My name is Carlos. I'm, I guess, the only bonded warehouse class 3 operator here in Tampa, Florida. I was just confirmed by U.S. Customs this morning.
All right.
So I wanted to learn, more. I've been in this business almost 40 years, very familiar with class 3. So I wanted to, learn from your perspective, but just letting you know that there is only few available. One thing on the CFS that you didn't mention is that whenever the cargo reaches the CFS station, you only have, I believe it's 15 calendar days to file an entry. If not, it's going to go into GO.
That's right.
So that's basically what I just want to, input into your conversation.
Carlos, it was a very nice plug, and it's nice to know that you're a Bond 3 facility. I imagine it's in high demand everywhere, brother.
We've been getting phone calls for the past 2 weeks, customers, and we basically are telling them we have a space as of today, but we don't know what's going to be tomorrow or the day after. So
right.
That's
very good.
What we're dealing with.
Well, thank you. I guess one additional point to that to consider in kind of going through these bonded facilities for everybody to think about is, there's always criteria. What's the minimum stay time? What's the this? What's the that? There's always things to consider in that arena because they've been so inundated. I've seen some say, well, that's great, but you have to do at least 6 months with me. If the tariff is lifted next week or next month or whatever it is, then okay, you're still going to pay for 6 months worth. So there's always criteria that goes into the selection process, but we may have a nice avenue here with Carlos moving forward in Tampa. So that's good to see. But I think on the supply chain strategy, that's what it boils down to, is what do we think that is going to happen here in the coming months? Well, what we're faced with now is these blank sailings, so if you want to get a shipment out of China right now, on 5/6, you say it's ready. The odds of getting a sailing, and it's going to take a few weeks, to get something on an ETD from China right now, because these carriers have all taken vessels out of rotation. They're not wanting to bring ships here half full, etc. So in thinking about that, it does mean that we should have longer lead times right now. Considering other Southeast Asia countries, whether it's Vietnam, Thailand, Malaysia, Indonesia, we're seeing a lot of those now. Those lead times, typically there's no direct sailings. So it's all going to be a transshipment that will then, have kind of be exacerbated with, a little less opportunity in how many vessels are going to begin with, plus a transshipment. I'm telling everybody, you really got to count on 45 to 60 days from the time you say something is ready, even to get it to Los Angeles. Right now, you want to build that kind of timeline into your clients. Are there better options? Other things? Yeah, potentially. But I think on the whole, that's probably where we are right now today, on the lead times, and the blank sailings are a very real thing. So, the planning and not over promising right now are pretty important because there's uncertainty in the market. So I don't think you want to go for that. The ocean pricing is still remained relatively low. The May rates came out, for all intents and purposes, very much the same. I don't think we're going to see a big influx here. It's certainly not in May. They're still changing every 15 days. So it's important on the 1st and 15th to continue to check on those. And see where the market has gone. We've seen the air freight pricing really fluctuate a bit more, frankly, because of those blank sailings. If you really need cargo here now, sometimes you're not willing to wait it out, that lead time, that transit time, and people are actually, increasing their air shipments when they really need to get product here. So I think the air freight's been a bit more volatile and has gone up a bit. Again, similar challenges, on the carrier options. They're really watching that quite closely to see, what kind of volume is being shipped before they commit to, sending multiple flights each week and things along those lines. So, seeing the air freight, stay pretty consistent or go up, right now. But the ocean freight has maintained its level, or even gone down to some degree. But I think I'm predicting that we will see an influx or an increase on that ocean freight pricing in particular starting in June. Historically, June, July, August has always been the peak season in the industry where we could expect the rates to increase and space to tighten up. But right now, I think it's anybody's guess a little bit, but I'm guessing that, and what we're hearing is that the rates will go up. We'll see every day that a deal gets done. These are all the variables that play into all of this. But one thing, that I heard multiple clients say from a production standpoint is that, again, they're rolling the dice that they believe that the deals will get done, even with China, in the next month or two, is what a lot of people are betting on, let's say. And so because of that, they've continued with production. They may not have stopped it. They may have been a little bit more select in it, especially if you've got relationships with your suppliers where they're willing or able to hold that cargo in China for free, or you can not have to pay them up front, and all of these variables that can occur. So I think it's an interesting strategy because, one of the things we're always thinking about is that from the moment this a deal gets done and the heavens align and the seas part and that all happens, you're still talking about potentially, a month to produce and then a big sailing boom. And so the production will get saturated, the sailing and the space will get saturated. The rates are sure to go up. And so, it is an interesting strategy to consider shipping now on goods you feel confident are going to sell, and even paying for what is a, bond type 3 facility, in the States for a little bit, betting on the fact that it is going to, a deal will get done, but you would have product here and you're ahead of that curve. So it's a very interesting opportunity that exists out there. But again, no right answer. It really depends on how confident you are, how you feel about it. But I am confident that we will see both the production and an ocean freight boom, for space and rates, whenever that deal is done, or whenever we get some finality there in the space. So a lot of things to consider as we kind of go into what's the best plan, for your business on how it can move forward. And really, at the end of the day, that leads to this slide here on the sourcing diversification. It's what the world is calling for, right now. I think even if a deal gets done, nobody believes it will be at, what it was or a level, but it's going to have, some percentage to it for sure, for the foreseeable future. How confident are you on, just sticking with China as your primary option? I think everything is screaming towards really needing to diversify with suppliers. There's both a short-term and a long-term play on that, but I think from the short term, it's trying to find, somebody who has the availability to maybe assemble, to do some things a little bit differently, just to be able to keep things going and have a different country of origin. And the long term is really trying hard to make a calculated plan on finding other alternatives and suppliers who can make the product. This is definitely an area where we're trending and want to be supportive as we get a sourcing division going. I've been fortunate enough to be in the industry for 25 years and travel the world. And, we do have partners who are very familiar with suppliers all over the place, who have, different options to consider and are able to then go out after that. So that plus people that we have that are specifically in the sourcing world, that's all they do, is try to go out and source product. We do have our Mexico operation based out of Mexico City that we're, going to continue to lean on to find different factories, solutions based on the product. So we would love to be a strategic partner with anyone looking to diversify their supplier base. There's some great tools that Import Genius and Panjiva, are two that we've used a lot on our side that are important as you want to vet, let's say, different factories. See who else they're selling to in the USA. You can run reports through these softwares that do require fees. We would be happy to run them on your behalf and be and help in the process with that. So it is a good vetting tool. You can search by all kinds of things. You can search by commodity, you can search by supplier, you can search by company name, you can search by a lot of different things in these. So they're very good platforms. Have all your clear production specs and the things that you really require of suppliers. It's probably been a long time since you had to do too much, of this sourcing. So really being ready, with that stuff. We've been, just today I sent out 7 different suppliers on furniture for company we've been working with out of Vietnam who's looking to source there. We've got, it depends the commodity, right? We got a supplier of shoes in Guatemala, Brazil, Vietnam. There's various different things. We're looking for ceramic goods out of Thailand. And so the more that we can get involved in helping to diversify the supply chain, that's the real solution here. But it takes time. And it takes a firm commitment to do that, because I think in talking to so many of our clients, everybody will appreciate, and I completely understand that, the Chinese just better. They were more responsive, the price, the production, the quality, the communication, just better. It's been hard to need to go outside of that. But I think that's the world we're living in. So we're certainly diversifying and starting to focus a lot more on Germany and the UK, other places where we can find manufacturing, because our business takes a hit too, when things from China go down, just like everybody else's. So diversification seems to be the long-term solution for us all. We would love to be avenues of support as we go out there and look for other products, other suppliers. The de minimis and the Section 321, to be blatantly honest, we don't do a ton of this, but it is an important piece of legislation that came out that has, again, yet complicated things. You've seen companies like Temu, all of a sudden stop advertising things on their website and pulling back on different things because a lot of them were indeed goods from China that they now no longer want to sell at that price point or can offer, period, because they don't want to bring them in. So there's a lot of different challenges to this, but we do have a number of clients who are using, let's say, Tijuana, various different places along the border, to bring in goods, not pay duties and taxes. And then as they sold them each day to different people, utilize the Section 321 as a real focus and strategy. Totally understand it. Now that too, is going to come with some extra nuance, duties, taxes, fees, problems, but depending on what your business model is, the products you're selling, how much e-commerce driven things you're driving from your site versus selling to, the likes of Amazon or conglomerates is also an interesting strategy to look at. Those are things that we can facilitate. We do work with a couple of different facilities in Tijuana that would be or along the border that would be good solutions here. So for now, it's just important to understand that, as of May 2nd, those exemptions for duty-free treatment are now gone, and so it's been a lot to adapt to there as well. So with that, this is some resources that I wanted to discuss with everybody here that are important things for everyone to have. So there are a number of free trade agreements that exist out there in the world with the USA. They are commodity specific, most of the time, but we have a resource and a website that you can search, all of those free trade agreements and really see, because it may change your diversification strategy. You may actually consider Morocco where you never previously would have. To then go hunt for suppliers and hopefully utilize us in the process to help you find them. There's some great systems from customs that you want to make sure that you're signed up are. I mean, there's so many in the last 60 days, there were so many different things coming at us that even US Customs couldn't keep up. I mean, nobody knew exactly how to process. There was a lot of uncertainty. So, staying up with what I would say is the more industry, vernacular on how the things that he says or that the president comes into fruition into what the real and when it starts. It's important to be signed up for those messaging services here to keep yourself completely up to date. This next one's a great one, which is Cross. It's a customs ruling online search system. This should be something that everybody's utilizing. You can research very specific past rulings from U.S. Customs on what is a commodity, if you're looking for validation on an HTS code, on what's the right one to use, on even country of origin requirements. I've seen this used a ton, on that as well, where there's previous rulings, somebody wanted to claim this and they weren't able to. So this gives you a window into actual rulings that Customs has made, that you can get familiar with the logic, the thinking, the interpretation, all of the above. So a very important portal to utilize. We talked about Import Genius, Panjiva. I would also tell you that those are important things to potentially check on competitors, right, who they're using. To keep your names off of those lists, we do have a service that we offer for that to make sure that your information is not provided via the FMC, that is where they extract all this data, the Federal Maritime Commission. So important to make sure you're buttoned up on that front. If you're not, you don't want your competitors to be able to see what you're doing. And then there's a couple other, informative webinars around the USMCA, the US-Mexico and Canada agreement, through what's called the NCBFAA, which is another good portal. That's something predominantly customs brokers used over the years, the National Customs Broker and Freight Forwarder Association. But again, just another resource to have as everybody navigates these tricky times. They keep pretty up to speed, on all the latest and greatest as well. So, these are things that we use daily. So they're important to share with everybody so that you have the options to utilize them. That's really it as far as my presentation goes, but I would love to answer anybody else who had any questions or thoughts or concerns or things that they were doing or strategies or really anything that they wanted to share. This would be a good moment for that.
I have a question. I'm just curious at what point do tariffs kick in? Is it when your goods leave the country of origin? Is it the time that the customs broker puts through the manifest, or sort of with these changing tariffs, I guess when do we know when they kick in and when aren't they relevant?
Yeah, that's an important piece of planning, isn't it, Emma? We need to know that. It's nice to see you here. Thanks for joining, and great question. I mean, I think it predominantly has always been based on the tariff rate in place at the time of entry. So we're legally allowed to clear something 5 days before arrival to the final destination port. That became important too with all these dates. But because of the changing landscape, what had happened was certain dates were put into effect. And so what we saw was if a cargo had sailed or was on its final leg of the journey to the USA by X date, then this duty rate did apply or didn't apply, depending on what he put out there. And so, now we're basically past that window. So that really took a lot more emphasis, I would say, in April, when a lot of these regulations were becoming finalized and, being put out there. And so then those dates became incredibly important. And, we've had wins and we've had losses there. We've had ones where we were able to get things in or submitted, beforehand, before that date. And then we've had some that, because they were going via Vancouver and then had to be trucked into the USA, well, technically that's the last leg. And so we missed it by a day or two, resulting in, tremendous duties. And so we've taken wins, we've taken losses on that front. But historically, it's always been based around the rate in effect at the time of entry. In this case, in April, we had a couple of those that were really based on, did it start the leg on this turn? And so that's a question I get asked all the time. Well, let's say a deal gets done. What can we expect? Is it going to be based on, a sale date, a last leg date? I mean, and who knows? I think historically what we've seen so far this year is that, there's a date that they pick, and if it's before or after this date, then it's going to apply. And so will that hold true when a deal is made? I guess we'll find out. But I hope that's a good answer.
Yeah, thank you.
Sure. But I'm quite sure you weren't the only one wanting to know that. Anybody else? This is for you guys here as much as anything.
Hello, I have a question.
Sure.
If you were an importer and you were going to send cargo to a bonded warehouse and you wanted to pull little bits of cargo out at a time, how does that process work? Is it advantageous? Do you have to pay, duties and taxes all at once? How does that work?
Yeah. So, number one, you want to be selective about the bond type 3 warehouse that you would use, because not all of them allow for that to happen. So you want to be wise and make sure you have that option. You do need a customs broker to do the warehouse withdrawal. That is an official entry that has to happen along with what is a formal entry to U.S. customs clearance that would then happen. And you should be able to indeed piece them out and take them out as you sell them or want them. Maybe you have a client who wants, a pallet worth of this and is willing to pay the duties, could be. Then you're able to take out just that pallet, pay duties and taxes on the value just for that pallet, and get it out of the warehouse with the duty rate in effect at the date of withdrawal, the day you take it out.
Perfect. Thank you.
I see Carlos shaking his head, so hopefully I did good on that one. Yeah.
Hello, my name is Luigi. I do have a question in regards to one of the slides you showed, section 321, specifically the $100 duty per item. So I am a furniture manufacturer. We import our furniture from China. We are just completing a project with them and have a shipment supposed to be picked up from Guangdong around I want to say May 9th. Once it hits customs, because there's about 124 items in there, is each 124 of those items subject to the $100 per item? Because this is the first time I'm hearing about this section 321.
Yeah, so let's think about that for a second. And what I'm hearing in your example is probably not. I think you're importing 124 of those items from China to the USA, right?
Yes, 124 chairs and tables to be exact.
Chairs and tables. Okay. So you would most likely indeed have to pay the duties and taxes on that upon arrival. Yeah, so I don't think the section 321, the only time that's going to apply is if goods are not entered into the USA commerce, right? And they are then shipped out, whether it's from that bond type 3 facility or a facility more typically outside of the country along the border, where a lot of times then you're shipping them out and you're selling it to Joe, and Joe's buying one chair and one table, and the value on that is $600. Right? In the past, you would never have to pay duties and taxes on that. And so it was an advantage. A lot of people would do that. But in your scenario, you would just have to pay duties and taxes on the entire chair and shipment when it arrives into the US.
Got it. Awesome. Thank you so much for clarifying that. Once I saw the slide and saw the $100 per item, I was like, whoa.
Yeah, no problem. Anytime.
Hey, Derek. This is Janae from IMO USA.
Janae, nice to see you here.
You as well, and thank you for doing this. I really appreciate it.
Sure.
As you know, I work for a German-based company. Right now, we are currently looking at bringing in components and setting up assembly in the U.S. So I was wondering if you could say a little bit more about this essential transformation, really speak to that a little bit more, because they're actually in their sales meetings next week and looking for feedback on our options pretty quickly.
Yeah, it's interesting, Janae. I would say that in that scenario, if you're bringing in components, and you're going to then manufacture those in the US or assemble those in the USA, really, and then it becomes a finished product here.
Yes.
Yeah. I still think you're going to have to pay duties and taxes based on the components coming in. Yeah.
So that's where some of the sourcing may come in, as far as it's of course engineered in Germany, but we're pretty varied as far as sourcing of our actual components. So I can see that already being helpful for feedback for them to really start to explore some other sourcing options for some of their components. But I was just wondering, if bottom line, if there's any real advantage to that, to bringing in components and assembling here. I can't imagine, unless it's, we're not looking to devalue anything, but ultimately, we're importing based on their marked up price. So we are owned by them, right? We're owned, and then we also have a separate entity in the U.S. So it's a little bit more involved as far as that's concerned.
Yeah, it is. I don't see a major advantage there, unfortunately. Okay. It would be one thing if you were, assembling them here and then exporting them out. That'd be a different animal for sure. But in that scenario, no. One of the things I didn't talk about that's been out there too, and pretty heavy dosage, is the first sale rule, which again was not overly utilized out there in the universe, but having a intermediary party be involved in a transaction allows you to claim the price sold to the original or first party involved, which that gets interesting. And so we've seen a little bit of a rise in what I would call trading companies, being out there in the world, where that trading company is acting as that middleman, so that the supplier is selling to them and then they are selling to, IMO, something along those lines. And then you're able to claim what is a little bit of a lower valuation based on the price they paid the factory. And, I'm not going to lie to you and tell you that is all being done above board, because it isn't. But people are looking for ways to, circumvent and survive.
Yeah, I got it. Okay. Yeah. And so I think I did see an advantage, because we do ship a lot to Canada. Well, we're in North America. So yeah, there might be some options there, but overall, that I appreciate it. Thank you.
Yeah, of course. Aaron.
Hey, Derek. That's not Aaron. It's Augusto from Michael Top Beauty. How are you?
Augusto. Yes. Nice to see you.
I got a question. So we are starting to see Amazon Canada as a possible business. So mainly we import here to the US, right?
Right.
But then once we're shipping out to Canada, is there anything that we can do to avoid paying US duties and then again pay duties in Canada?
Yeah. What I would do in that scenario is that I would get registered in Canada as an importer, right? And I would send the goods directly into Canada, whether you're using a 3PL there or not, depending on, how the arrangement with Amazon is. But I don't see any major value to bringing that to the US.
If I cannot get a full container into Canada, can I bring in and separate, and then part stays here, part goes? Is there a way to do that? Do you know from the top of your head?
Yeah, you can bring anything you want into the States and then segregate things out and ship what you want to Canada. But the real question is, what's the duty advantage for you, to how to avoid double duties? And even in that scenario, you wouldn't, And so I think the best thing to do is, if Canada is going to be that may be an initial solution. But as you ramp up with Amazon Canada, you start to see more traction, you start to see more things, or even from the get-go, it may well be worth taking it directly to Canada, getting set up as a registered importer into Canada, which is something we can facilitate, and we've had somebody else on the call we've done it for already in the past, I believe. And, you know, that's going to give you the option to import directly into Canada, pay the duties and taxes that would be due just directly for that import, you know, and then sell the goods to Amazon in Canada. And unless you're really altering the product here, there's really absolutely no advantage and only disadvantage to bring it to the US.
Got it. Thank you.
Sure. Of course. All right. Any other brave souls here? Okay. Well, look, hopefully everybody found it to be impactful, educational, you know, all of that. Again, really appreciate everybody showing up. Love to be impactful for you out there in the world. So I'll make sure everybody gets the spreadsheet here, or the presentation that we sent out via email, and has my personal information. Love to be involved.
Excuse me, I actually have a question, but I couldn't figure out how to unmute myself on that screen.
No problem.
I don't normally do this, and I'm on my phone, and I was flipping around, and I kept. Anyway, do you mind if I jump in with a question?
No, please.
So, I do apologize. I joined late, so you may have talked exactly about this point, but there may be somebody else curious as well. And it was talking about rulings about, I guess, specific case scenarios. We get machinery imported from China, and the purpose of the machinery is actually we're using American raw materials and American labor to create products here, but we can't buy the machinery here. It doesn't exist. So we bring it in from Asia, and we've set up a whole bunch of factories all around the US for over the course of the last decade. And now this kind of hamstrings a couple of people. Now, the tariff amortizes because it's equipment and not like commodity on a piece by piece basis. But at the same time, you know, people are saying, well, we don't want to build this manufacturing capacity because, you know, if it will have the machine running for, let's say, a decade, let's wait this out. Right? So what's happening is this is pushing people to import because they're saying, well, it'll cost me a little more, but if we were looking at $100,000 tariff to bring in the machine, if the machine was worth 60, we'll continue bringing in the finished product, and maybe that tariff will go away, which is actually the exact opposite of the idea here.
Right.
This is the position we're into, is we want to bring in machines to make jobs.
Right. Boy, it's so interesting. That's a really interesting case. But I mean, I guess I can see their logic too, right? But that defeats the purpose, like you say, in the long run. So I'm not sure how to navigate that one, to be honest.
Okay.
I don't think there's anything you're doing right, wrong, or different. You know, that it's just sort of the effect of the tariffs, unfortunately.
Okay. So again, that's my fault for joining late. I wasn't sure about what the rulings and stuff on a case by case basis was about. I'll have to watch the recording of this. Thank you.
No, but I'll tell you what, I would love to connect with you on the side about that, because that's real specific, and there may be some things I haven't immediately thought about on the spot, but that we can do.
All right, cool. Yeah, and then I can explain to you the types of things we're making, maybe, like it would be useful to know about.
No doubt. I'm sure there's some opportunity within that.
All right, thank you.
Sure, thank you. All right. Well, I saw a little chat activity. Anybody else? All right. Well, listen, I really appreciate even, sharing any of your day here. So I appreciate everyone who joined. I'll make sure you guys get a copy of the slides, the presentation, and look, anything you need, I want to make sure that I'm on the list of the first call there. I'm waiting for those calls and be here to help everybody as we navigate it together. Thank you, guys.